Broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the April edition of Digging into the BI. This is where members from the Maryland chapter and the DC regional chapter get together, look at the member-only magazine, the BI, and we examine some of the stocks that are in there and look for your conversation and involvement. So tonight we're going to be looking at four new stocks. We're going to be looking at Dorchester Minerals LP, Service Now, Intuitive Surgical, and Decker's Brands. And we're glad that you're here. We have a nice turnout, and again, we're very happy to have people from all over joining us. So here's our standard disclaimer that we use in our community, and that we're doing these presentations for educational purposes only. We believe, as Better Investing does, that you should conduct your own review and analysis of any company before you make an investment decision. We will try to alert you when we own these particular stocks or they're in our club portfolio, but please understand again that we expect you to make your own assessments on those. If we do show you anything outside of the Better Investing website, the presenters are not endorsing or promoting that website or products or services, and keep that in mind. And yes, this is being recorded, and we will put it up on our YouTube page, which we finally got caught up with last month. So, a little bit again for those of you that don't know a little bit about Better Investing. We are a investment education organization, and anytime you see a blue underline on any of these pages, make sure that's a hyperlink. So make sure to be able to get the slide deck that's over on the right-hand side. It's free. You can share it with other people in your club, other people that are interested in that you're interested in talking with about investing, and take a look. But we are an investment education organization. We focus on long-term fundamental investing, and all of us that are making presentations are volunteers in the Mid-Atlantic region, which means that we live in either Maryland, DC, or Virginia. You do not have to live in those areas to participate. In fact, I see several people from outside there. Welcome, and we're glad to have you. Here is that YouTube page I was telling you about. You can go to youtube.com. You can either search under Digging into BI, or you can see our channel itself. We're trying to inch up over 300 subscribers. Yes, that's not very big in the whole scheme of influencers, but we'll take it. One of the things we ask is that in return for this free education program, that you do three things: that you go to the YouTube page and you like the video, and then you share the video with others, and make sure to also subscribe to this channel. That's how this algorithm works. That's how we can be able to spread our word about long-term fundamental investing to other people that don't know about BI. Here again is the next slide that I want to be able to point out is that most of these we haven't really had trouble with in a while, but it's this green one right here where you have the handouts. There we have four completed SSGs for you. Again, you can download them, and you'll be able to see each individual's judgments that they made up on it. And you can also get the entire slide deck that's there. Again, you can share that with other people in your club, or that you're interested in chatting about investing with. So why are we doing this? Well, we think in this area that it's a great way to be able to sort of be part of this community, but also to be able to sit there and show you, how, if you're uncertain of your judgments, if you don't really know some of the things there, showing us how we do our stock selection guides, how we end up making our selections for what type of stocks. And if you're not a member of the Better Investing community, again, here's a hyperlink up at the top, again, blue underline, and that you can get a free 90-day trial to be able to try it. So if you're not in our group, go ahead and try that to be able to help it out. The other thing we like to do is we like to be able to promote best practices of a long-term fundamental investor. And we also like to be able to promote any of the programs that are going on in either the Maryland or the DC regional chapter. We have model clubs, and we also have a Club Connect program that we'll talk about. But again, it's a way to be part of the community, whether you're in Maryland, DC, or Virginia, or if you're from other places and just trying to be part of the larger Better Investing community. Welcome. So in just over an hour, we're going to go over four stocks. We've already mentioned what they are. Two come from our member-only magazine, and that's the monthly stock to study and the undervalued feature. And then the others will come from some other place inside from your membership, either the website or the magazine. Sometimes it can be personal experience. I think tonight we have them from screening tools for the most part. So anyway, it's just a great way to be able to show you all the resources that you get with your membership in Better Investing. Here's the stocks. And again, this is available to people both inside the community and outside. Again, another hyperlink up at the top. But these are the stocks as they were presented, ServiceNow and Decker's Outdoors. They were announced on early February of this year. And so you can already see they have the ones for May, and pretty soon they're going to have the ones up for June as well. So again, one thing that could be really helpful if you're a regular attendee is go and take a look at this and do your own SSG on one of those stocks so we can be able to have a lively discussion at the end. The other thing to be able to talk about is we want to make sure you don't miss any of the upcoming future announcements, either from headquarters or from your local chapter. If you sign in here under My Account, this again you have to be a member for, you'll be able to see the email, product, and subscription information, this green circle. It actually converts over to this screen capture on the right-hand side. Here you can be able to sign up for the local chapter news, and you can also sign up for the Better Investing weekly e-newsletter that comes from headquarters. And you have to click both of them before you hit Save Changes, otherwise they won't stick. But again, it's a way to be part of our community and see what's going on. So this, again, the BI weekly newsletter comes from headquarters outside Detroit. It's for members only, but it highlights a lot of our educational programs that are going on nationally, as well as events, and including also first cuts and other stocks that are out there right now. In fact, I'm sort of highlighting one of them here. Someone had presented a first cut report on Intuitive Surgical, one of the ones we're going to be looking at tonight. You also see some great things with learning centers in terms of how to use like the audit and ratio features to be able to help improve your judgments. Take a look at these things and make it a regular part of your thing. It comes out on the close of business Thursday. If you signed up for it and you're not getting it, I would check your spam filter. We also have a Facebook page for the community here, and where we sit there and announce our upcoming events. This, again, you don't have to be a member of BI. You can be a non-member. Great way to be able to reach out to other people. If you like that, then you can also sit there and feature and highlight your club. So if you're always looking to be able to tell people what you're doing, you can be able to sit there and say, my club met. You can give the name of your club and put that out there. And that way you can be able to let other people see what you're doing without going into a lot of detail. But if they're interested, they'll reach out to you. With that, I want to be able to give it over to Cynthia, and you can tell us a little bit about some of the things that are going on in the Maryland chapter. You have two big events coming up.
Awesome. Thank you, Kevin. Yes, Talk It Up Tuesdays with the BI virtual. It's a virtual series, and Talk It Up Tuesdays in the month of April. We'll be back go-to meeting, and we are just structuring to have conversation. We do have some starter wording, starter phrases to kind of get us started if it gets silent on us. But it's just it's a way that we can just be comfortable and just talk about anything, and then probably kick up a conversation. So Talk It Up Tuesdays, bring your conversation, bring your questions, and let's all talk about it together and answer it together, come with solutions, or even thoughts about it. It doesn't have to be right or wrong or indifferent, but it can just be a talk that we can all have when we talk it up on Tuesdays. Another big event we're going to have, we have a few. They have not been solidified yet, a location and times, but we're looking to do a total wine meet and greet. We're also looking to do game day in the summer. We did a game day in the winter, and we are looking to do this one's solidified. In May, we'll do the top 100, 200s presented by Roger. So I'm excited. More information to come back out and check all of these places that Kevin shared us on this call, and look us up, the Maryland chapter, with all of our events. Thanks, Kevin. On you.
Yeah, and you also have for people that want to do an in-person learning of the stock selection guide and you live in and around Southern Maryland, there's a
Thank you
place down
for
on the
that.
lower left. So
Yes.
good to take a look at it. Cheryl, why don't you tell us what's going on? There's some other things that we don't even have on this list that we can tell people about. Go for it.
Yes, we're excited to do in the first Saturday in May, which is May the 2nd, a club recognition event starting at 10 in the morning till about 1:30, recognizing not only clubs that are having anniversaries in multiples of 5 years, but also any club in the area that wants to speak to us and to the audience. It will be virtual about how they lasted as long as they did. What are some things that have contributed to their longevity, as well as maybe a stock tip to share.
Thank you. All right. And Cheryl, why don't you tell us about your club?
We are the Model Investment Club of Northern Virginia. We were started in 2008, currently have 14 partners. We meet on the third Tuesday of the month virtually, and there is the link to the meeting. The next one is going to be April 21st from 7 to 9 p.m. And you can also dial in using your phone with those numbers. The education and the stock study have yet to be decided, but there is our point of contact email. So if you want to get in touch with us, there it is. And we are very welcoming to visitors.
Florentia, why don't you tell us about our club?
Florentia, you have to unmute.
Did I tell people that we're volunteers?
Thank you. Thank you
Go for it, Florentia.
Yes, welcome everyone. So our Montgomery County Model Investment Club, it meets virtually. We started in 2017 and currently have 7 partners. We meet on the 3rd Wednesday of every month. This month we'll be meeting on the 15th of April. Our meeting is from 7 to 9, and here's the link and if you'd like to join us. Here's also information in order for you to call in if you'd like to call in. The education segment that's coming up is 6 signs your SSG might be too conservative. And then the stock study is Carol. Again, the information is here. Another thing that's really nice, once you are a part of our organization or you just like to visit, we do have a quarterly social, and it's a lot of fun and just good people to be around and learn a lot about stock investments. So please join us.
Daniel, tell us all about the MIT Investment Club.
Yeah, so good afternoon, everyone. So I'm part of the, our club is part of the DC regional chapter. Our name is Millionaires in Training, and I promise we drew straws to come up with the name, but we're formerly known as MIT. We started in 2019. We have 13 partners. Our next meeting is April 11th. We meet every second Saturday of each month, and generally about 9 or 10 times a year. There's a couple of months that we give everybody a break, but overall we kind of stick to the second Saturday each month, and it goes from 10 a.m. to noon. It's online. Ever since the pandemic, we've been meeting online. Our educational topic coming up is TBD as of today. However, prior to our meeting this Saturday, we will have something in place, and then we're also going to take a look at our stock study, which will be Decker's as well.
Thank you. And Cynthia, tell us about your club.
Our club is in the Maryland chapter, and we are in the Black Investment Club. We are online only and always have been. We started in 2021. It was 6 partners, and we meet on every Sunday. The second Sunday of every month, 7:30 to 9. Our education is reviewing banks and brokerage. We're making a change. And then our stock study this coming Saturday will be ADDUS, ADDUS. I'm the point of contact. My email is there. And definitely we have open status, so you can come and visit as well. Just shoot me an email and I will shoot you the link and you can join us on the second Saturday of every month. Thanks.
Thank you. Okay. Cheryl, why don't you tell us about the Club Connect program?
Well, clubs are always in need of members, the ones I've talked to anyway, because they have attrition, people leaving and whatever. And so this is a way for them to then fill out a form and be available to talk to prospective new members. And on the flip side, people who are independent investors who would like to have the social connection of a club. You can also submit your form to be contacted by clubs in your area. And now pretty much with everybody virtual, that has kind of not mattered much anymore either. But there's a way for you to connect. Thank you.
Okay, and let's continue. So this is digging into the BI. We do like to be able to talk a little bit about the magazine that you get. This is the April issue. It comes out electronically earlier than it does for the mail, but you can also get this and see it on a computer, laptop, tablet, smartphone, or any electronic devices. Over on the left-hand side is what you can do when you get it on an app or on a phone. And you can also look at this by signing into Better Investing and looking at the e-magazine. And to be able to get to that is that if you see over on the left-hand side, hold on, let me get this right. There we go. Where you see the Better Investing for magazine and mobile devices, that's where you'd sign in. It's a different sign in than what you get for the other ones, but you can do that. You'll come over here and you can also take a look then for the magazines and look at the magazine issues. The other thing is that the featured stocks, the stock to study and the undervalued feature, whenever they say there's additional analyst reports, it's always going to be where this red box is. So you can go over there and get that additional information they used to put in the magazine, and now they just say, hey, look, we'll just put it up here for you. One of the things I really like about this issue, it's always been that way, or at least it has been since 1984, is that they always have the cover story is the top 100 companies held by our members. It used to be that people would have to fill in a postcard, and send it into headquarters, and then they would tabulate it. Now it's just basically a list of the people that what they're doing in My iClub. Now, not everyone is in that. Some use another software, but regardless, it still gives you a really good wide range of what people are doing and the like. And it's a great way to be able to sort of check on some of the ideas. And as Cynthia says, the Maryland chapter has for many years had one of their directors, Roger Cronchi, turn around and sort of analyze all the companies that are in there to take a look at it. I think one of the things that I remember when I first came in about 25 years ago is that the former sort of chief columnist, as well as the president of the organization, Ken Jenke, said that he would always look at it and look for the new ones that just moved into the top 200, because those would be ones that are starting to show interest in our community. And you may want to look at those to be able to see here they're showing the big movers, but take a look at the list itself. And they have one page that's just for the new to the top 200. And there were about 15 different companies in there, and there were some pretty interesting ones. So use that if you're looking for a shopping list of good stock ideas. Finally, at the end of the magazine is the list of all the events that are coming up. Many of them have already passed, even though we're just on the 6th day of April, because they were all set up for like either the first weekend in April or they were in March. But the fact is that because the national convention is going to be in a couple weeks, I think a lot of people are not doing events right about now. But there are some annual events coming on up. I see Kent's Alabama chapter, the South Alabama Emerald Coast is having stuff going on. So go ahead and take a look at this. Many of these you can attend to online without even having to leave your home to take a look at it, or some of them are only just a short drive. So keep that in mind when you're looking for new places to go and check out. Now that we've done all that, now it's time to be able to look at, and the reason why we come together is to be able to look at some stocks. So Cynthia's going to start out with Dorchester Minerals that she found through a screening tool, and then I'm going to be looking at the stock to study, which is Service Now. So with that, Cynthia.
Thanks, Kevin. Awesome. Good evening, everyone. Again, as Kevin said, I'm just going to make one correction. Is the Bonham. So it's 2 O's, Bonhom. So
Oops.
I get it all the time, Bonham, but that's the only thing. So let's get started. So tonight I'm going to walk through how I discovered, analyzed, and evaluated Dorchester Minerals. The ticker sign, as you see there, is DMLP. And I use and then of course using the Better Investing Stock Selection Guide. But most importantly, I'm going to show you how to think about a stock that like this, that is not of the norm. So just gonna throw a little twist in there because DMLP does not behave like our traditional growth stock. Thank you. All right. And a little bit about it. I'm gonna go past it. So just look at that. Let's go to the next slide. All right, so as Kevin said, I discovered this on the stock search tool. And on the front screen, you would just click on the hourglass, the magnifying glass. I'm sorry, the magnifying glass at the top of the screen is going to bring you over to what's on your right hand of the screen. Yep, you got it. And this is going to bring you to your stock search tool. And this is where you can find some predefined choices, or you can select some choices. And what I used for screening in this one, I asked for small cap companies with strong grades in growth, profitability, and financial health. And at the bottom is what I populated. And then I sorted it by small companies to find Dorchester Minerals. And then, of course, the next slide, please. I just dug a little deeper in the ISRG tool to see what this opportunity really was with Dorchester Minerals. Here, DMLP, I'm going to stick with Dorchester Minerals, a little bit easier to say, has a very simple business model. And this is key. They don't drill. They don't operate wells. They own materials and royalty interest. And they get paid when others produce. So quick, simplified business model they have here. So production generates revenue, and that revenue flows directly to the investors. Next slide, please. They operate across multiple basins in the U.S., which provides geographic diversification. So they're not dependent on just one region or one play. Next slide, please. All right, here they are assets and base reserves. They also have strong reserve base, which supports long-term income. I'm going to emphasize that, which supports long-term income potential. So while this isn't a growth story, there is asset backing behind the income. Next slide, please. All right, it is here. Okay, so this is the most important slide in this entire presentation. If you don't remember anything else that I say this evening, remember this. Dorchester Minerals income fluctuates with oil and gas prices. So the dividend is not fixed, it moves with the market. DMLP income fluctuates with the oil and gas prices. What's interesting because of the times we're in. Next slide, please. All righty, so this brings us to our macroeconomics. Global events, conflicts, supply disruptions impact energy prices, which directly impacts DMLP, revenue, and the investor's income. So this is not just a company story, it's a global energy story. Next slide, please. Here I jumped into the SSG, just a little analysis here. When I analyzed using the SSG, I saw a little something that was important here. So sales and earnings and the profits are variable, they jump. They're not consistent. And I know that we look for up, straight, and parallel, and we look for consistency, but this one's a little different. So I wanted to bring it to your attention. I did in this slide deck, when you get it up close to you and you have it at your own discretion and read it, if you read some of those small boxes, it'll give you some additional information. But my forecast is a range between 3 to 5. I played with that for the sales and EPS. I did 0 to 5. When you look into the analyst, you'll see, even with the growth here, you'll see anywhere between 12 to 17, higher numbers from 5 to 9. I stayed conservative because it is an income-driven, commodity-driven, not a growth company. And as we go on, you'll catch on a little bit more. But that's because performance is driven by commodity prices and not a business expansion. All right, so why that stands out, we'll go into it a little bit more. This is a high margin structure, and but it's still a very efficient model. Next slide, please. Now I jump right into the valuation. I kind of kept the slides a little short, but now when it comes to the valuation, traditional tools like the PE doesn't fully apply. The stock is priced more on yield and market cycles than it would the earning multiples. And if you think about that, if you want to ask me questions later, we'll jump into it. But here I gave it a high price. I want to see if I can see my screen of 58.1. And I gave it the low price of 26.7. The low price over 52, I think it got down to like 20 to 23, $20 to up to $23 range was the low. And then the high got up to, I think it was like 32 to 48. So this is, I just kind of use it and play with it. But again, using, being mindful, this is not a growth, your typical growth company. This is more of an income, a market-driven, a commodity-driven company. Next slide, please. I think I'm on point with my little slides. Okay, the SSG shows potential upside over the next 5 years. But it is important to understand that this is cycle-driven, not growth-driven. When I did the SSG, it came up and it gave me a high number for the average yield using the forecast high PE. It was anywhere like 100. One was 141. I changed it. I wanted to be conservative again because the dividend yield that they were giving out was a range between 10 and 12. So I did 12. And 12, if you populate 12 in there over to your right, you'll see that it the yield comes back to be 13.5%. Not in the green, but not in the red either. Okay, so let's go to the next slide and I'll try to wrap it up with some sense here. Pretty small as I can see. All righty, so here in my summary, DMLP. Dorchester Mineral is a small income focused energy royalty company. It's generally well managed, but recently the performance reflect commodity price fluctuations. You'll see that for 24-25. When I said traditional valuation suggests that it's overvalued. So traditional don't want it looking at a growth company. If we were to see it through those lens, it looks like it's an overvalued company, but the metrics fully don't apply here. The best way to view this is a satellite income position. So you probably would ask me, well, why would I want to put it in my portfolio? So I would say to you that it's a worthy candidate to consider holding or selective adding to your satellite income position. And that's if you are focused, if your focus or your portfolio, or your goal is income driven, more so than a growth driven. Just wanted to look at it a little different. It intrigued me when I saw it. And I would look to accumulate shares below $25 to align with the 15% return target, and the 3-to-1 risk reward position. The next slide, I think, is the next person. And I'm right. So thank you. But we can talk about it later. If you have questions, I love them and I'll answer.
Thank you
Thank
very
you, Kevin.
much. Thank you, Cynthia. Glad for this. And it's always good to hear different people give different views on companies. And yeah, I've looked at some of these oil and gas ones, and there's sometimes they are kind of tough to use our methodology, but you can learn a lot from what's going on with it.
Yeah, it was so intriguing.
Yeah. So I'm going to talk about the stock to study, which is ServiceNow. And you can see that it shows up not only as our stock to study, but it's also in the ticker heat map as well as in the first cut report. And it's a pretty recent one here too. And so this is sort of, it started out as IT software management, and they've really sort of branched out into a whole range of other things. So one of the things they've done is that they have a network of partnerships, and you can saw some of the companies that were over there before, like Uber and Adobe and stuff. But what they've been doing is they'll help them sort of build out some software or some technology, and then they will use that to be able to help apply to other companies that they're working with. They do a steady stream of acquisitions that go with it. So those two things sort of go hand in hand. And there is a concern not only with this, but this is one of the reasons why Microsoft is being beaten down right now, is this emergence of AI software development that they think they're going to cut into Now's business model. And I'll show you why Microsoft and stuff like Meta are also impacted by that. Right now, again, 97% of their revenue comes by way of subscriptions. In this kind of field, there's things called software as a subscription. There's also platform as a subscription and infrastructure. Those are all sort of the things that happen in cloud computing. I'll talk about that in just a moment. One of the things it's kind of interesting to take a look at is just to look at the visual analysis overall. And one of the things I like to do is I like to be able to find when the CEO took over. And I learned this from reading about the founder, George Nicholson. He put a star on his visual analysis when that new management took over, because after about 2 years, they can basically have full ownership of everything that's going on. So you can see this is where Bill McDermott took over, and he's an experienced person who's been with both SAP and 2 or 3 other tech companies as well before he came on over to ServiceNow. And this was, like I said, presented 2 months ago. It was selected, and it's really stayed about the same price. So since it doesn't pay a dividend, it means this company, if it follows a methodology or their intent, would be to double in price. But overall, you can see a lot of good up, straight, and parallel lines with this. So as I said, ServiceNow is actually in an area called Platform as a Service, and you can be able to see all of the cloud computing that goes on. Their business model is basically one of about 3 different ones. It's infrastructure as a service. That's this one here, IaaS. There's platform as a service, and then there's software as a service. Software as a service would be like if you were to buy an annual subscription to, Microsoft suite of tools like Word and Excel and the like. Platform is where you may develop the software yourself, but you need someone to be able to protect the stuff on the back end, your operating system, some of the development tools that you need. And they may also do some of the cybersecurity and protection that goes on in infrastructure. So you can be able to see that it's a little different than some of the others, but what they all have as a benefit in the cloud is that they're all based on reoccurring revenue. And that's a way that you know that you're going to get a really good, consistent, straight line in the visual analysis. So again, what they do is they really sort of streamline the enterprise operation. Let's say you have a particular product that you use to be able to track things inside your office or your business. You may go with them and say, look, help me sort of develop the software and give me the infrastructure behind it to be able to make it go forward. So again, they started out in this IT service management area. And under Bill McDermott, they've really been sort of branching out into other things, including cybersecurity and risk management, customer service management, That's where they sort of overlap a little bit with Salesforce and HR delivery services, where they compete with some of the HR delivery people as well. So it just sort of gives you a little bit of idea where they are. So their target market are basically going to be these large enterprise companies, and that usually need financial services, healthcare, and any kind of cybersecurity protection that goes on with it. So they're dealing a lot with the CIOs and the chief technology officers, HR people, as well as IT managers, are sort of the people that they deal with in companies that they're trying to work with. So that sort of shows you where it is, but they're really predominant here in the US. Again, US companies can be global, but they're headquartered here and they're sort of focused in this market in particular. Now, here's one of the things I always like to do is I like to see sort of how big the overall area is for a company to be able to grow. It's called their total addressable market. There are people that can do intense calculations to be able to get that number right. I basically just take what does the company say their total addressable market is, or what can I find from it? And one of the things that's happened is you can see that the TAM, or total addressable market, for ServiceNow has jumped to about $600 billion per year because of some of this stuff that's going on. McDermott initially had it around 90 billion. He thought they could be able to really branch out into some of these other fields as a platform base. And so they have this great room to grow if the vision that he has for this going forward will continue. So there's a lot of great expansion drivers in software, enterprise software, intelligence that goes on. And they've been able to really show steady growth since they went public in 2012. They first were, it was originally started by the founder by himself while he was working for someone else. It took him 2 years before he hired someone else to go with him to be able to branch out. But some of their competitors, you can see them over here on this side here. Some of them I've never heard of, but you do see Salesforce. You do see SolarWinds. You can see over here SAP. That's one of the people that the CEO used to work for. You can see a wide range of different people. So they really compete along different spots because their platform allows them to be able to give the protection for anyone, whether, again, they're in HR or whether they need security and IT protection. If you look at the stuff on Manifest, this shows up as a pretty decent number. That's a sales growth of 16%. That's excellent. And all good, solid quality. Maybe the par isn't up as high as we'd like, but there's enough in here to be able to go, okay, it's pretty good. Someone has their microphone open, so they may want to mute yourself, please. So if we look at this under core, and we'll take a look, I took out those early years here because one, they sort of bounced around a lot, and two, this is also when the CEO sort of took over. And if you see this, we do have really good straight lines. And if you come down here, it's a little hard to read. It's kind of small, but the sales growth line, that may not look like much, but that's 28% annual sales growth. Okay, and that's a pretty darn straight line. And their earnings growth is 78, almost 79%. Again, really, really steep growth going on there. And again, that shows you a lot of the things that are going on. They're acquiring companies. They don't pay a dividend. They buy back some of their shares, but they're really doing it to be able to go on out and build out different things that go on with it. One of the things they have besides acquisitions is they got to protect themselves with patents. So they have over 2,100 different patents that their company has. Either there's a family of them or just different things in there. So they're like a healthcare company. You've really got to be able to protect your patents. So you spend a lot of time with lawyers to be able to protect some of those things going forward. If you look at
5 minutes, Kevin, 5 minutes.
Thank you. If you look at this overall, some of these numbers, they really don't jump out at you and going, wow. I mean, the pre-tax profit on sales, it's been slightly below average over the entire 5 years. However, these last 2 years, when they've really started to make some of the switch into some of the cybersecurity and other things, they've really sort of jumped in here, and they're above sort of the industry average with it. If you look at their return on equity, we'd like to be able to get stuff in the mid-teens. They do have that. But again, they're below the average for the industry, which is generally in the low 20s. But where they are better, and this also has an impact on return on equity, is that they have slightly less debt than most of their competitors, even with all the acquisition. And you can see how they've been slowly bringing that down. So again, they're using their cash to bring down their debt, and they still have a really good return on equity. Not excellent, but okay. So this is sort of a good, but not as great as I'd like to see it. So here it is. I'm going with sales of 18 and 20 with you. Look at that. And you go, wait a minute, that seems kind of high. But as I just showed you, the sales line was 28%. And some of the other numbers I saw, like again, Manifest was in the 16 to 17% range. And then just using the preferred procedure, I was able to, it showed out to be 20%. Again, they're using a lot of their surplus money to be able to acquire other things, and they're not paying out debt, buying back some shares, but not great amounts of it. So when we look at this, this is one of the things the story talked about. If you read the story that's in the magazine, is that when you have one of these big IT companies, you're not, if you're a beginner, where we tell you generally don't go over 30 for high PE, here you have one at 63. And again, if you look at this 63 compared to what it's been over the last 8 to 10 years, this is really the lowest it's been ever, and the like. That's fine. And they do talk about this in it, that maybe sometimes with these companies, you have to use non-GAAP earnings to be able to take a look at it. So read the article to be able to find out what's going on with it. But I felt that that was a pretty reasonable number based on where they are now and what's going on with it. Conversely, it's also the same with with the low PE. Again, these numbers are higher than we would normally do it, but I think they're also a reflection of where this industry is and what's going on with it. So those sort of how I set my high and low PEs with it. And with that, I end up getting an upside downside ratio of 6.8 to 1 right there. So it's clearly in the buy zone that we're seeing with this. A great opportunity to go forward with it. Um, and then again, it doesn't pay a dividend. So here we are, we're getting a total return of about 20% per year based on these estimates. Now, there are some problems with it. Like I said, the evaluate management is good, but not great. The other thing is that the big threat that, is AI going to make this company irrelevant, just like it would with Microsoft and Meta and the like. And the fact is that if you believe, as this authors of this article in the magazine, is that there's a great opportunity going forward. They have these patents to be able to work forward with it. That I think that this could be a great opportunity to be able to get in on a company that normally does not come down to this kind of a low and reasonable price. So it's a large size, fast growing company. It's in the S&P 500. It's also in a subgroup called the S&P 100, which are the top 100 companies inside that 500. So those are the behemoths that are in there, and they're part of that. Again, these future sales and earnings are really good. Management metrics just okay. It's overvalued if you look at things based on the current PE of 61. I get an average PE when you take the forecasted high and low is 55. So it is overvalued. But again, for its particular time, it's really not a bad spot to be in. I get it as a buy up to 124. It's currently selling at 102. And this is a good growth play that's selling near its 52-week low. And that's a rarity that you don't always get. And it's, I think, because of a lot of the things that are going on overall in this market, as well as a concern that's going on with the potential for AI. And I think that this is a company that can be able to withstand that and has talented people to continue forward. So that's my presentation. Thank you very much. Now we're going to go on and we're going to look at the two that are going to be done in plus. We're going to have Florentia tell us about intuitive surgical, and then Dan's going to tell us all about Deckers. So take it away, Florentia.
Okay, we have Intuitive Surgical Inc. This is a medical robotic giant in the industry. It had a very, very early start. Next slide, please. We're going to look at a short video, which is going to give us an overview. And it's in the right-hand corner, whoever's regulating the slide at the bottom, right-hand corner. There you go. So they are primarily using robots in order to perform different surgical procedures, and they're less invasive. They have a shorter recovery time, and more people can have access to complicated types of surgeries. You can close that out, please.
We help hospitals work smarter.
Perfect.
Our goal, more people get the care they need, increasing access at scale. We succeed when we ask and answer big questions. How do we engineer the most minimally invasive surgery? Replicate human senses through robotics. Use data and AI to make surgery more reproducible. Our answers are creating a new vision for the future of human health. Together, we're transforming care.
Okay, you can close that out now. Thank you.
Let me see if I got to the right spot. Here we go.
There you go. Okay, next slide, please. All right, so here their global footprint. Most of their systems are deployed in the U.S. 6,000. They are actually located in Sunnyvale, California, and they've deployed over 10,000 systems globally, with 6,000 in the U.S. They also have 4,300 patents. So this is showing you their global footprint, and you can see that most of it is in the US, but the expansion is happening in Europe and other places as well. Next slide, please. So here's some of the numbers as recent as 2025. You can see the procedures that they performed over time and the systems that they use, as well as the systems in place in 2025 and the hospitals globally. They're trying to expand those. So in all of these areas, they're actually expanding, and they're also leaders in robotic surgical research and publish 48,000 articles. So they are like a model company for robotic surgery. And of course, since they actually started way before others in 1995, they've got like a head start. Hence, they are the giants. Next slide, please. So here are some of the areas that are important to consider: quantitative performance, unified ecosystem, and integrated intelligence. This market is currently experiencing a transformative super cycle driven by the expiration of foundational patents and the integration of artificial intelligence and shift towards minimally invasive surgery. So here's some information regarding the current market estimate, which is 8.5 to 10.2 billion. So it's continuously rising. The market value projection is 25 to 34. So you see a lot of room for growth, as well as the CAGR projected at 12 to 16% over the forecast. And this is really important to kind of consider the other companies that are up and coming and trying to penetrate this field of medical robotic surgery. Next slide, please. So for this quant rating, it is the healthcare sector. It's mainly based around equipment. We can see the ranking here, the sector ranking, and then the industry ranking, which you can see is 20 out of 123. So the price range of all of the companies that are their competitors was $3.70 cents up to 482, with it being the highest. These are some articles. If you were to go online and look for the company, these are some recent articles. So you can see one as recent as March 22nd, 2026. So they keep things updated and abreast so that you can follow them and find out more about the company. Next slide, please. Some of the areas, of course, they're developing, producing, and seeking the expansion of different markets. Some of the surgeries that they perform are bariatric, cardiac, colorectal, general surgery, gynecology, head, neck, thoracic, and urology. Next slide, please. Some of the facts that are important to mention: they have a recurring revenue dominance. Approximately 83% of total revenue is recurring, and that is coming from the equipment or the accessories that are used when you're operating. So for the surgical procedures, it's like you use them once, and then anyone who has the machines, they have to repurchase. So that's where most of the revenue is coming from. You can see the massive profit margins here, which is saying that they have a near monopoly in terms of pricing power and proprietary technology. As I mentioned earlier, they actually have over 4,300 patents, so they do have a dominance over this industry. Their balance sheet is nearly a zero debt, which you'll see later on when we look at the judgments. And the procedure-driven growth, its annual procedure volume growth is historically 40 to 20%. And then the premium valuation is the price to earnings is it's magnified, and the investors pay a premium for the consistent double-digit growth and high switching costs to hospitals. Next slide, please.
5 minutes, Florencia, 5 minutes.
Thank you. So competitive revenue growth, if we look at the competitors here, the ones that I selected were Stryker and J&J. If you look at the right-hand side here, you can see that Intuitive Surgical has a higher growth rate of 15.1% as compared to the others, and the peer group average is 8.8% in the industry, so it's exceeded all of those. Next slide, please. The earnings growth, we can see that the only competitor here would be J&J, and J&J has a different kind of procedure. They have a strategy that is basically the former procedures, and they have actually entered into the robotic medical procedure. So they're trying to penetrate this market as well. But you can see that Intuitive is doing very well. Next slide, please. Here's some comparative perspectives. You can just glance at them when looking at its closest competitor, which is J&J. Looking at the areas of the strength, future tech, financial risk, and the execution. Next slide, please. So the pre-tax profits on sales growth, we can see it is at 30% for Intuitive, and that is above the industry average as well as the peer average and its direct competitors. Next slide, please. Here's some risks to consider when thinking about this particular stock. The primary risk is here, high valuation and cyber breach. So we know that's really important. And then the internet. So these are the two areas: Intuitive Surgical, which is the medical realm, and then we have the AI realm, which is on the right. So the impact would be the stock volatility as well as the patient safety. And then, of course, when thinking about the technology component, the internet component is the global internet outages that can affect this company. Regulatory oversight, liability, and lawsuits because of the things already stated. And then, of course, there are privacy laws that have to be definitely regulated. And then the growth risks, there are new competitors, as we just mentioned, and then funding dependency on tech giants can change in the future. Next slide, please.
2 minutes, Florencia, 2 minutes.
Thank you. Thank you. So here are some metrics for the front side. We'll keep going. Next slide. Here I took information from Seeking Alpha in order to kind of justify my judgments here. One is from the historical EPS is 18, and we can see up here it is nearly 17. And for Yahoo, we can see that the sales is between 13 and 14. I use 14. Next slide, please. The evaluation, we can see is 30% for the pre-tax profit, going in the right direction. And we can see that the return on equity is almost at 15 and almost, as we stated earlier, 0% in terms of its debt. Next slide, please. Here's the earnings history. It is on sale. We can see that it's 64, 5-year, and then 57 for the current price. The current price is $452, and it's near the 52-week low. Next slide, please. It is a buy at this time, and it has an appreciation of 214%, which is really high, but since October 22, it has been about 270%. So it's not even a surprise with an upside down ratio, 5.5 to 1. Next slide, please. And we have, the projected compound annual return is anywhere from 20 to 25%. Next slide, please. And here's just a glance at the historical and potential future performance of this particular stock. If we say that it's $100 that has been purchased, then we look at on the right-hand side, we can see there's a gradual increase, and it's always above all of the other areas for the most part. The next slide, please. So it's a large-sized company that dominates robotic surgical procedures. It's opposed to capital sales and generates most of its revenue, up to 85% from recurring sources. It's considered a best well-managed company in the healthcare sector with an A grade. It is a buy, and it's a worthy candidate for others to explore for this particular stock. Next slide, please. And I think that's it.
Thank you, Florencia.
Thank you.
And last but certainly not least, Dan Parker's going to talk to us about Decker's brands, and this is the undervalued feature this month. So take it away, Dan.
All right, thank you, Kevin. So I've mentioned a little bit earlier, I'm from the MIT Club. We're mostly concentrated around the DC suburbs here, and primarily in the Dulles Corridor region near Dulles Airport. We do have a member from Bowie, and I think we have a couple of members from out of state. So tonight I'll talk about the Decker's brand. It's on the New York Stock Exchange. The symbol is DCK. I found this stock, which was mentioned earlier in the April 2026 BI magazine in the undervalued stock section. This is a high growth footwear powerhouse. It captures its market share through innovative performance technology and strong brand loyalty. Next slide, please. So a little bit about the background. As of the 5th of April, the price was 98.31. Last fiscal year just ended here, March 31st, 2026. The industry is footwear and accessories, and it's in the part of the consumer discretionary sector. It's a medium-sized company, 1 to 10 billion in sales with a health grade of B. Next slide, please. So Decker's is a global leader in designing, marketing, and distributing innovative footwear, apparel, and accessories. It was developed for both everyday casual lifestyle use and also high performance activities. The products are marketed primarily under 5 proprietary brands. However, there's about 3 of them that really jump out. That's the UGG, the Hookah, and the Teva. Next slide, please. So the way it got started in 1973, the founder created a new kind of footwear, and this was out in Santa Barbara, California, near the surfing community and a lot of surfing type interests. And he created a simple, innovative striped flip-flop, and it just basically took off with the surf lifestyle. It took off by storm. The company now makes its money by selling a lifestyle and a brand promise. And they're mostly focused on managing the design and the distribution of premium footwear. They outsource and let the lead the manufacturing to global partners and third-party vendors, primarily in Asia. Within Deckers, they break their sales out by brand category into 3 reportable segments. Of course, there's UGG, which many of you will be familiar with. In 2024, the net sales was $2.5 billion, and the percentage of the sales of the company was at 50.8. Hookah was $2.2 billion, and that's a high-end running shoe, and that was around 45%. And then there's a group of other that includes Teva, which is the biggest part of that. That was 2.20 million, and mostly sandals, sports sandals, and that's a percentage around 5% for the company. Next slide, please. So Deckers is also involved in the community. They have a saying, be good, do good. They also have this Deckers Art of Kindness, this AOK, where twice a year they have volunteer activities, and the volunteers from the company have put in about 20,000 hours through these AOK events. Next slide, please. So within the industry, there's a couple of things I want to point out here. Within the industry, the growth is driven by this term athleisure, right? So that's basically athletic and leisure, and also performance. So the industry is defined by the blurring lines between the high performance athletic gear and then everyday fashion. So, there's 2 of the fastest growing subsectors within the industry. One of them is performance running, and the other one is premium comfort. So Deckers has a foothold in each one. In the performance running, they have Hookah, and the premium comfort, they have another positive development for them is there's a shift that's going on, shift to direct to consumer. So the major players are aggressively transitioning away from traditional wholesale department type stores. Your brick and mortar type stores, your malls, we're seeing these decline in malls and these types of things, but they are transitioning toward own e-commerce and branded retail. And this allows for higher profit margins and direct control over the customer data. And then last on this page is the asset light manufacturing model. Most industry leaders operate as a design and marketing house, and then they just outsource a lot of that to third-party manufacturers, Vietnam, Indonesia, China. That's how they maintain that high operational agility. Next page. So there's been a premiumization and pricing power shift that the industry has seen towards premium price points, primarily around $140. Despite the inflationary pressures, this is where this particular industry is at. And also from a brand loyalty and proprietary technology perspective, think specialized foam insoles in the shoes nowadays. This allows companies through their pricing to maintain gross margins over 50%. And then, of course, the competitive landscape. We've all heard of Nike. We heard of Adidas. The market has been dominated by those types of players. However, it's currently and increasingly being disrupted by challenger brands like Deckers, brands like On Holding, and brands like Brooks. The challengers are capturing significant market share in their specialized niches. Okay, so let's talk about the market. So the market has the total addressable market is like $529 billion. Deckers went through, or Deckers had a 6-for-1 forward stock split in September 2024. Going back a little bit farther back in 2016, they had a very large company restructure that they undertook. And both of them have worked quite well for them. They're continuing to seek market share expansion. They're scaling their HOKA global retail footprint. They are particularly in the Asia and Pacific regions. They're expanding into apparel and leveraging the high brand loyalty from those HOKA and UGG fan bases, and of course that direct to consumer capabilities, which keeps the margins high. And then last but not least, Deckers is operating in a favorable environment. There's an increasing global demand for performance running and premium comfort footwear. There's this shift that's taking place toward athleisure, the athletic and the leisure, and of course, the new technology that's being put into shoes with their foam cushions and the like. There's also a resilience of premium consumer spending despite these economic fluctuations. And there's strong brand heat allowing full price selling rates and industry leading gross margins. Next slide, please.
5 minutes, Dan, 5 minutes.
Okay, thank you. So we'll take a look at some of the charts now. So here's a peer comparison. If you take a look at this, you'll see who some of the competitors are. Croc, Own Holding, and Birkenstock Holding. These are just some, but the takeaway is there's a remarkably consistent and high quality performer, significantly outperforming its peer group and the broader industry average. So Deckers is in a pretty good spot. Next slide, please. So from a historical sales perspective, we generally like to see train tracks up straight and parallel. Not exactly quite that, but it's looking pretty good. In this red box that I have highlighted here on the right-hand side, we can see what the sales and the earnings were from last quarter, from a year ago, and the percentage of change, which is pretty good. And then we can also see the analyst consistent estimates, which are right there. From a sales perspective, the ACE is looking at 8.1. And then the EPS is 10.1 in their evaluation. Next slide, please. Okay, so from a sales and management perspective, through my forecast percentage, how I got to these numbers. For sales, I got to 8, and for EPS, I got to 7.6. So from a sales growth, I took a look at the following three: Value Line, Zacks, and Simply Wall Street. And I took their rates and kind of averaged them out and came out to the 8 for sales. And pretty much for EPS, I took Value Line, Saks, and Yahoo Finance, averaged them out and got to a 7.6. The trend is up on pre-tax profit on sales, also on return on equity, and it's down, which is what we want it to be, on percent debt to capital. Next slide, please. Okay.
2 minutes, Dan, 2 minutes.
Okay, so taking a look at the PE, Deckers is currently, the PE ratio, the earnings and dividends. So Deckers is currently experiencing a significant valuation disconnect. Its earnings are at record highs, but its market valuation, PE ratio, has dropped well below its historical averages. Next slide, please. And as Deckers became more successful, investors grew more confident in the company's future, willing to pay a higher premium price to own the stock in 2024 than it did previously. And the 6-for-1 forward stock split and also the restructure of the company had a lot to do with building that confidence back. Next slide, please. So as we look at the numbers and the average high price, forecasted high price for the next 5 years, 173.6, and then if we look at the selected forecasted low price, that is 88.5. And when you put all that together, it comes out in the buy zone at a 7.7 to 1 upside downside ratio. Next slide. And this is what that looks like on the chart when we show those numbers as it falls out into the upside downside chart. Next slide, please. So in conclusion, the Deckers brand is a Deckers, that's the ticker symbol DEC, DECK. It's a medium-sized, moderate growth company. It's well managed. DEC is undervalued, trading at its 5-year average. I'm sorry, that's incorrect there. The 5-year average is the last piece, but it is undervalued. It's a worthy candidate to put on a watch list, but it is also a buy at the present moment. Total return 7.7 to 1 upside downside ratio, and it is a buy up to $109.80. And that concludes my presentation.
Thank you, Dan. All right. So now that we've done that, we're going to ask all of our presenters to be able to sort of outline where they think their stock fits on this life cycle. Again, here's the 4 stocks we have and where they came from. And so we'll just jump into it. Cynthia, you want to tell us why you picked that location for Dorchester Minerals? Make sure you're unmuted.
Okay, can you hear me? I'm sorry.
Yes, there we go.
So it's a small company, but it's a mature growth. They have their niche. They know what they do, and again, they work off of royalties. There's no explosive growth, even though it's a small. They are stable, and they're pretty much set where they are. And again, they work off of they're driven by commodity prices. Microeconomics. So at this point, they are going to have some ups and downs, but for the most part, they are a mature company because of their niche and what they do.
Okay. And ServiceNow, they're in a well positioned to grow with that company in that industry in terms of their cloud computing that's going on. The big threat, of course, is will they be able to survive over AI? I think there's enough resources there. But again, their growth rates have been really, really high, and I think there's still a lot of potential growth. As you can see, their total addressable market is significantly higher than what it was previously. Florentia, why don't you tell us about Intuitive Surgical and why you have that location for it?
So I selected this location because this company is very strong, as I already mentioned. However, there are other companies that are penetrating the market. So while it has just kind of continued to grow, it's not as explosive as it once was, especially when we think about the penetration from the other companies that are seeking to expand their robotic surgical procedures as well and the equipment. So it's a strong company. It's a grade A company. However, it is not growing as fast as it once was, but it continues to grow and mature as a solid company. It will be around. Thank you.
Okay. And Dan, tell us why you have that location for Deckers.
Yeah, so Deckers is in a pretty good position. They've been around for a while, but they've increased their number of employees on the average over the last 4 years by 12.8%. They're now up to 5,500 employees. They have a very good, very well-defined business plan. And with the consumer shift that's taking place between athletic and leisure, they're in a prime position to have some growth, partial explosive growth, but good growth based on their overall objectives and their overall plans.
Okay, thank you very much. All right, so now we're going to turn to you. We've been talking for the last hour and 15 minutes, and we want to see not so much which company you like so much that you want to buy, but which one the presentation interests you enough that you want to do your own further research on it. Cheryl, can you release a poll or do I have to do that?
I'm doing it.
Okay. Okay, let's see. We got about 60% people voting. This is a somewhat close race. Well, maybe not.
We
I
can't
just,
see it.
Well, you can, if you're a panelist, you can pull out and see how things are happening in real time. If you do a poll and you do, and if you're an organizer, you
Close
can
for
see it.
second place. Very close for second place.
Yes, sarcasm is Kent's native tongue. We got
I'm
a
not
few
being
more.
sarcastic. It's true.
Well, we're at 73%. Can we get up over 75? Can someone else give us a vote or two? Throw us a vote. Doesn't cost anything. Doesn't get there. It is, we're not moving. Go ahead and close it out, Cheryl.
All righty.
And do I have to share that so for people to see it now? I think I do.
I've got it on my screen. Is it not showing in yours?
No,
I
it
see it.
isn't.
Okay, then why don't you go ahead and do so?
All right. How do I? Good question. How
Just
do I?
open
I've
up
got it.
poll.
I'm seeing it on my screen, Kevin.
Okay.
I see
Anyway,
it. Kat.
well, I don't know if it's coming up, but anyway, the fact is Intuitive Surgical had 38%, and ServiceNow was at 25%, and Dorchester and Deckers were both at 19%. So Intuitive Surgical was the big winner. There you go, Florentia. Just like you convinced our club to not only put it on the watch list, but immediately turn around and buy it. You just have that gifted tongue to be able to get people to want to buy what you're presenting. So there you go.
Well, it's a great company, though.
It is. It is. So anyway, with that, Kent, are there any questions for any of our presenters that people would like to, that you'd like to be able to share and they can discuss?
No questions at all. So if anybody has any questions, if you raise your hand, we can unmute your mic and let you ask your question in person.
Yeah, it's really a bunch of church mice tonight. Everyone's
okay.
quiet. No, we need talkers.
I've got Dan
what you do.
Bishop showing a question mark. Dan, let's see.
Here,
Those are comments.
Oh,
Those are
okay.
comments.
All
I
right.
got it. Okay.
This is awful. I'm disappointed.
I think this is great, Kevin. You all explained everything so well. I am impressed. I have now more research work to do. Thank you very much.
Okay. Anyway, we'll just continue going on here. So if you need to be able to see any more of us, come join us.
Oh, you'll need to share your screen, Kevin.
Am I? Oh, I thought I was.
There we go. I had to hide the poll.
Oh, okay. That would explain. Can you see my screen now, or do I have to? Oh, wait.
No, I don't
There
see
we
your
go.
screen.
There we
There
go.
we go. I got it.
So, again, if you want to be able to ask any follow-up questions, here's the Digging into the BI email contact. If you want to be able to reach us, Cynthia and other people in the Maryland chapter, here's theirs. Here's our DC regional chapter, and here's a picture of all of us at the last in-person BINC, and several of you are in the audience tonight, so thank you. So please come. It's only, we're just 2 weeks away, 3 weeks away from BINC. Please come on out to Chicago and hang out with us. It will be fun, a good time had by all. And there's a picture of just a few of the people that have presented at this Digging into the BI since we started 5.5 years ago. Again, you don't have to be a member of the BI or the DC regional chapter to be on our mailing list. Carol doesn't inundate you with lots of emails, just educational things and notices about this. So please sign up. We'll take you regardless of whether you're a member of BI or not, because we're just trying to be able to help point out the benefits of a long-term fundamental investing. Kent, why don't you tell us, as you always do, about volunteering and how great it is?
I was going to say, and speaking of long-term benefits of investing, volunteering is a great way to get some really good long-term benefits. I don't know if anybody noticed, but this entire operation is run by volunteers, all of Better Investing, as well as Digging into the BI. And as volunteers for your chapter or for other Better Investing activities, I'll speak for myself. I have learned many new skills, and I have been working on improving my investing skills. And so I've learned a lot just working as a volunteer for Better Investing. But in addition to that, I get things such as discounted rates for educational events, such as the Better Investing National Conference, which is being held in Chicago in a couple of weeks, as well as getting access to the stock selection guide tools and cheap subscriptions to various other activities and websites. So the tools come as a free benefit for chapter volunteers. And so that's something that is a really great benefit. And just getting to learn and getting together and meeting other folks who enjoy talking investing is a great benefit to being a volunteer. So next slide, please.
And so for next month, we're going to have 2 new featured stocks. It's going to be Equifax is the stock to study, and Neurocrine Biosciences will be the undervalued feature. We have 2 more that our presenters are busy looking at to see with it. Actually, we have just one. We need a 4th presenter for next month. I do see some of you in the audience. If you haven't presented in a while, we'd love to have you fill in on Monday, May 4th. You'll be able to pick your own stock to be able to see what's going on. Love to have you be a part of this. This is how this system works, is that if you're a regular attendee, we'd hope that you'd want to be able to present a stock, whether you live in Maryland, D.C., or Virginia, or you're visiting us from elsewhere. This is how this community works, is we work with each other and we share with each other. So please help us out.
And we're willing to help you with your investment analysis if you want to present and it's a first time for you or a second time. We can give you a hand.
Exactly.
Sorry, Kevin.
No, that's fine.
And you got some people who know how to do PowerPoints as well. And
There
we're willing to help.
do we have anyone who's a PowerPoint ranger?
Yeah.
Do we have any PowerPoint rangers in the audience tonight?
What's a ranger?
That's Cheryl. Cheryl's a PowerPoint ranger.
Cheryl's a PowerPoint ranger.
Yeah. There we go. All right. So we also have stuff up on Manifest Investing, the dashboard. I do have to actually update this. I'm a lot behind on that one. Hey, I just got all the webinars up there. This one will go up a little bit quicker from there too, up on the YouTube channel. But please, for all this work for free, make sure to be able to like and subscribe on YouTube. Please help volunteer and help out with this. Be a great way to be able to, promote your club, even if you're not in the Maryland and DC, Virginia region. We love hearing about clubs. Love to hear what you're doing. It's what I think a lot of us get most excited about. And Cheryl mentioned that with our club anniversary in May, I always love hearing all the different people talk about their clubs and what they do. So please do that. It's how we make our community. Here's the dashboards for all the ones for up at Manifest. These are free. You don't have to be a subscriber to Manifest, although many of us do subscribe to this program. It's something different than Better Investing itself, but decide what's best for you in terms of what's going forward. With that, one last chance to see if we have any other additional questions. Kent, do we have any? We're all quiet. Sounds quiet. Again, there's a hyperlink up at the top.
All quiet on the western front here. So.
Or on the southern front, as it is for you Alabamians. Here it is. Here's a hyperlink up at the top to be able to do it. We'll keep this open for another minute or two, but please, if you want the slides to be able to take a look, open this up and turn around and, download those handouts that you see there. Again, you can share them with other folks as you see fit. That's what we're here for. Thank you very much. We look forward to seeing you either in Chicago. If you are, please come on up and say hello to us. We love hearing from other people across the country. And make sure to join us next month when we sit there and do this again, and we'll dig into the BI. Thank you very much, all. Have a good night.
Good job, everybody.
Yeah. I am going to close it out. It looks like we're down to just a few of us.
Okie
Good
dokie.
night, all.
Night.
Good night.
Thanks again for all your help.